Welcome back to another elite trading tutorial. Today you are unlocking a massive concept. You are diving deep into one of the most powerful institutional tools in the market. This concept is known as the inverted fair value gap or simply the inverse fair value gap. If you have been struggling with Fakot, this strategy is going to change your trading. Many retail traders look at a traditional fair value gap and expect an immediate bounce. But what happens when the market completely ignore that zone and smash right through it? That is exactly where the magic of the inverted fair value gap come into play. It represents a completely shift in institutional order flow and market delivery. Today I will show you exactly how to identify, draw and treat this setup step by step. You will cover the core mechanic, the physiology trap, and the exact entry rule. Make sure you have your notebook ready because this 13 minutes masterclass is pure gold. Let's head straight over to the chart and break down the foundational theory right now. A standard fair value gap is a structural imbalance created by a sharp 3 candle sequence. It occurs when candle 1's wick and candle 3's wick do not overlap at all. This leaves a clean open pocket of empty price action. Instead, the massive second candle in a bullish market. This imbalance represents an area of infilled by order left behind. In a bearish market, it represents a vacuum of sell order waiting to be mitigated. Retail trader and standard SMC trader look at these gaps as as reliable support or resistance. They wait for price to retrace into the gap to catch a continuation move, and why standard fair value gaps work beautiful in a trading market. They often fail completely when they fight. Most trader panic, take a loss, and do not understand why. But professional traders don't get mad when a fair value five. They look for the flip. That fight zone instantly transform into a completely new institutional point of interest. The process of inversion is based on the principle of support turning into resistance. Imagine a bullish fair value gap that everyone is watching for. A potential long trade price push the zone, but instead of bouncing, a massive bearish candle cuts through. The candle doesn't just speak through it, it closes completely below the entire gap. The moment a candle body closes past the boundary, the bullish fair value gap is dead. But instantly, like a phoenix from the ash, a bearish inverse fair value gap is born in its place. The exact same price zone that was supposed to act as a floor now become a ceiling. The institutional order flow has flipped entirely from net long to net short in an instant. Now when price retraces back up into that exact same zone, you look for sale. It is a beautiful mechanical way to trade alongside the real market maker. Let's look at the opposite scenario. or for a bullish inversion to make it completely clear. This is a gap created by a fast downward move where sellers completely dominated. Normally, you would expect price to hit this zone and reject downward to continue short. However, the market suddenly shift and an aggressive bullish candle secures upward. This green candle completely to brush and closes the firmly above it. This tells you that the institutional sellers have been completely overwhelmed by massive power. The bearish fair value gap has now been breached, invalidated, and successfully inverted into a bullish inverse fair value gap. The old supply zone has officially transformed into a high probability demand zone. As a disciplined trader, you now wait patiently for price to drop back down into it. When price mitigate the onset of this newly formed bullish inverse fair value gap. You look for entry. This flip capture the exact moment smart money trap the early retail short sellers. It gave you an incredible edge because you are reading the momentum of trade liquidity. Markets do not move randomly, they move to seek liquidity and engineering trade. When smart money wants to accumulate a massive position, they need counterparty liquidity. They purposefully engineer standard fair value gaps to induce retail trader into taking position. Retail trader see the gap, place their order and put stop right outside the zone. Once the retail order are heavily clustered, the institution intentionally smash through the zone. This aggressive move trigger at the stop loss, clearing out the retail money completely. By breaking through the fair value gap, the institution activate breakout order and stop out simultaneously. This create an intense pool of liquidity that allows smart money to fill their real order. Once their real massive order are filled, they leave the inverse fair value gap behind as a footprint. When price return to the inverse fair value gap, they protect that zone to defend their no position. By trading the inverse fair value gap, you are literally trading the exact footprint of institutional manipulation. If you get this wrong, you will constantly lose money on false structural break. The absolute golden rule of the inverted fair value gap is the candle body closer. A simply weak violating or piercing through the fair value gap boundary is not an inversion. Wicks represent price rejection, meaning the liquidity was swept but the zone held. If a candle wicks through an fair value gap and pulls back inside the original and fair value gap, is still valid. To get a true inverse fair value gap, you must wait for the candle body to close completely outside. The body represents real volume and sustained institutional commitment to the new direction. If you are looking at a 50 minutes chart, you must wait for that specific 50 minutes candle to close. Do not anticipate the close and do not enter why the candle is still actively moving. Patience is your greatest weapon here. Wait for the definitive closing print on your chart. On start, body closes outside the zone. The inverse fair value gap is located in and ready to trade. An inverse fair value gap on a 1 minute chart does not hold the same way as one on a 4 hour chart. To build a highly profitable strategy, you must always look at higher time frame conflicts. The best setup occur when a higher time frame inverse fair value gap align with your lower time frame on trade. For example, if you stop a clean daily or 4 hours inverted fair value gap, mark it out. This higher time frame zone acts as your major directional macro base for the day. I'm sorry. Once price enters this 4 hours inverse fair value gap, you immediately drop down to lower execution time frame. You can use the 15 minutes, 5 minutes, or even the 1 minute chart to find a micro setup step. If you see a micro inverse fair value gap form on the 1 minute chart inside the 4 hour zone, it is powerful. This alignment of time frame create an incredibly high win rate trade with minimal risk. Never trade lower time frame inverse fair value gap blindly against the dominant high time frame trend. Always trade with the heavy institutional flow pushing from the daily and weekly chart. An inverse fair value gap is not just a random box, it has specific internal price levels to watch. The most critical level within any fair value gap or inverse fair value gap is the exact 15% midpoint. In institutional trading, it is precise 15% equilibrium level is called. Consequent consequent engrossment acts as a massive financial magnet for algorithmic price delivery. When price retraces back into an inverse fair value gap, it will very frequently target the exact 15% line. Sometimes price will just touch the open of the inverse fair value gap and immediately placed off, but often it will draw deeper into the zone to test the consequent encroachment level. If price retraces to the 15% level and holds with strong wicks, it is a perfect confirmation. However, if a candle body closes past the 15% level, the inverse fair value gap is starting to weaken. You can use a standard Fibonacci tool set 0.5 and want to find this midpoint instantly. Marking this level helped you refine your entry and set price risk parameter on your trade. And smart money always wants to buy when prices are cheap and sell when prices are expensive. Therefore, you should never buy a bullish inverse fair value gap if it is sitting in a premium market zone. Similarly, you should never sell a bearish inverse fair value gap if it is sitting in a discount market zone. To map this out, measure the current trading swing leg from the absolute high to low. The top 15% of that interswing leg represent the institutional premium pricing zone. The bottom 15% of that entry swing leg represent the institutional discount pricing zone. If you want to take a short position using a bearish fair inverse fair value gap, answer it is in the premium. If you want to take long position using a bullish inverse fair value gap, either it is in the discount. When an inverse fair value gap aligns perfectly with a discount zone during a bullish trend, it is highly explosive. Combining array matrices like this filter out the low probability trade completely from your play. This ensures you only risk your capital on institutional great step with massive upside. An inverse fair value gap becomes 10 times more powerful when it forms directly after a liquidity sweep occurs. Look for price to aggressively take out a major old swing high or an old swing low first. This sweep triggers buy side liquidity or sell side liquidity pulling. Retail stop into the market immediately after taking that liquidity. Look for a sharp violent reversal displacement candle. If that displacement candle break an opposing fair value gap, it creates the ultimate inverse fair value gap setup. The combination of a liquidity sweep and an immediate inversion shows massive institutional intent. It proves that the institutions have swept the market and are now violently reversing the trend. This is the exact setup that leads to those massive green expansion candle on your chart. When you spot this combination, you can trade with immense confidence and strict discipline. In the next section, you will break down the exact entry execution protocol step by step. Let's move smoothly into the next phase of this masterclass to see how to execute flawlessly. Now that you have established the structural foundation, let us focus entirely on how to execute, knowing where the zone is made. Nothing if you do not know how to pull the trigger. There are two primary entry methods when trading an inverted fair value gap on any time frame. The first method is the direct limit order entry placed directly at the open the inverse fair value gap. And this aggressive entry ensures you never miss the trade if the price just taps the zone. The second method is the conservative entry waiting for a lower time frame confirmation and set the zone. For example, if price reach a 50-minute inverse fair value gap, you drop down to the 1 minute chart. You then wait for a micro market structure shift or another micro inverse fair value gap to form and set. This double confirmation method drastically reduces your risk and increases your overall risk to reward ratio. Both methods are highly profitable, but you must choose the one that fits your trading psychology. And whichever entry execution protocol you choose, consistency and discipline are the ultimate keys to Sucus. Sucus, let's look closely at how to properly place your protective stop loss using this step. When trading an adverse fair value gap, your stop loss must be placed using strict mechanical rule. Never place a random stop loss. Place it on your emotion or how much money you want to risk. The safest place for your stop loss is right behind the swing high or swing low. For a long trade, your stop goes below the swing low. Format the displacement leg. If that swing low is too far away, you can use a more aggressive stop loss structure. In this case, the unvolatility candle is the exact candle that closed toward the fair value gap to invert it. If price reserves and closes big and said that candle structural low, the step in is invalid. By keeping your stop mechanical, you remove all fear and anxiety from your daily execution. If you get stopped out, it simply means the market shifted and you accept the small loss. Now let's move forward and discuss how to target high probability take profit levels dynamic. You never guess where to take profit. You let the market's liquidity map it for you. The most logical target for any adverse fair value gap trade is the opposing pole of market liquidity. If you are in a long trade, your primary target will be the nearest buy side liquidity. These include old swing high, equal high, or major high time frame clean resistance level. If you are in short trade, your primary target will be the nearest sell side liquidity. These include old swing lows, clean equal lows, or major high time frame support level. Another highly effective target is an NFP standard fair value gap on the opposite side. And and you can also use a fixed risk to lower target, aiming for a minimum of 1 to 2, securing partial profit at major structure bond is a great way to creating consistent return. Let's look at how to manage the trade actively once the price start moving in your favor. Once price expand away away from to move your protective stop loss to absolute break even. Moving to break even eliminate your financial risk and aggressive give you a completely free trade. However, be careful not to shock the trade by moving your stop loss to early the market needs. Breathing around to fluctuate and build order volume before expanding aggressively. If you move your stop loss too tight, you will constantly get taken out before the move happens. Trust your initial analysis and let the institutional algorithmic delivery do its job completely. If the market structure shift against you on a higher time frame, you can exit manually. Otherwise, sit back, relax, and let your take profit or stop loss behind automatically. Now let's break down the critical concept of displacement and why it validates the entry. Displacement is the absolute engine behind every single highly successful inverted fair value gap step setup. Displacement is a sudden, violent, and highly aggressive movement in price action delivery. It looks like a series of long tail candle body with very small wicks. This visual pattern prove that big institutions are aggressively injecting heavy capital into the market if unfair value is broken by slow, choppy, and overlapping candle that is not real displacement. Choppy price action represents a lack of institutional interest and has a low probability of holding. You want to see powerful candle smash right through the fair value gap zone like a knife through butter. That strong energetic push confirm that the market makers are aggressively shifting their base. When you combine heavy displacement with a clean candle body closer, you get a premium setup. This displacement leg creates the very market imbalance that you trade every single day. Always you look for energy and speed in the candle to validate your chosen trading setup. Next, let's look at a live chart demonstration of bearish to bullish inversion seconds. And the retail short are usually waiting at this bearish gap expecting price to reject downward. Price retrace up into the gap, but instead of dropping, a massive green candle appears. This expansion candle completely engulfs the entry bearish gap. Strategic effortlessly, the candle body closes firmly above the upper boundary line of that bearish fair value gap zone. This exact closing point signifies that the bearish gap has officially been completely inverted. You now draw a clean rectangular box across this newly formed bullish inverse fair value gap zone. You patiently wait for the next few candle to retrace black down into or no box. As soon as price dips into the inverse fair value gap, you lock or long entry confirmation or stop loss goes safely below the low of that massive bullish displacement candle. This is the exact step that catch the absolute bottom of a major trend reversal. And this setup occurs when a strong trend suddenly loses steam and reverses violently downward. First, you identify a clear, valid bullish fair value gap left behind by pure standard retail trader. Look at this box as a major support area to buy more, but suddenly a high impact noise event or institutional selling wave hits the asset market. A massive energetic bearish candle brings down and cuts straight through all bullish box. The candle body closes. The bundle closes completely below the absolute lowest line of that bullish fair value gap structure. The old diamond zone has now been completely destroyed, and turn it into a heavy supply zone. This is your cue to immediately stop looking for buys and flip your BS to short and extend that box forward in time and wait for a corrective bounce back up into it when price test the underside of this no bearish and fair value gap. Exact your short position cleanly, place your stop loss safely above the high of that intense bearish breakout candle. And let's dissect exactly what this mistake looks like so you can avoid it entirely. You see a bearish fair value gap and a bullish candle speak aggressively upward right to it. You get excited thinking the zone is breaking and you enter a long trade immediately, but before the candle time frame ends, seller push price at the wall, back down the candle closes, leaving a massive wick above the fair value gap, but the body stays inside. This is not an inverted fair value gap. This is a clear liquidity sweep rejection. The institution uses that way to grab liquidity before continuing the original downward move because you did not wait, not to grab liquidity before continuing the original downward move because you did not wait for the candle body close. You could trap it in a loss. Never let your emission force you to exact trade on and incompletely protect your capital by strictly enforcing the body closer on every single trade. Waiting for the closes save you from thousands of dollars in unnecessary retail trading losses. And another value gap that for at midnight is not the same as one that form at night and 9:30 a.m. Institutional and curtain operate strictly based off specific time of the day known as kill zone. The three major kill zones are the ASEAN season, London season, and New York season. The highest probability and fair value gap always form during the London and New York season open. London season open occurs from 2 am to 5:00 am New York local time zone. New York season open and AKS launch occur from 7:00 am to 10:00 am. During these specific windows, the volume and volatility in the market are at maximum level. If you see an adverse fair value gap form outside these hours, it is highly likely a low probability trade. Focus your energy entirely on trading within these highly volatile institutional time windows, matching the right concept. What the right time gave you a massive mathematical trading edge. Let's see how to map out a complete daily routine around this specific curves. An inverted fair value gap is amazing on its own, but confluence market and startable on of the best tools to combine what your inverse fair value gap is the institutional order block. Order block represent the exact area where market maker heavily loaded their massive position, often when unfair value gap gets inverted on order block form directly right next to it when price reacted simultaneously. This creates an incredibly dense wall and wall of institutional support or resistance on your chart. Loud sellers or buyers cannot easily break through this double wall of heavy market volume. When you see this specific confluence, you can confidently increase your overall trade quality, your overall trade quality. It gave you a clear structural stroke of exactly what this smart money is different. Look for this overlapping zone to build a highly robust mechanical trading plan. Now you are ready to move into the 5-10 minutes to warm up this winter strategy. As you enter the finally part of this masterclass, let's master top-down analysis to really exactly you must never look at a single time frame in absolute isolation. Your analysis should always flow seamlessly from the macro down to the macro structure. Start Start your morning by opening the daily and the 4 horse chart to find base. Look for a major liquidity pulse or a high time frame imbalance that price is currently drawing toward. If the 4 horse chart is strictly bearish, you only look for bearish inverse fair value gap setup on your high grade time frame. K zone is market drop down to the 50 minutes chart. The 50 minutes chart is where you want to see the actual displacement and inversion. When the 50 minutes candle body closes outside the opposite gap, your zone is set. You can execute directly here or drop to the 1 minute chart for ultra high risk. The structured multi-time frame approach keeps you on the right side of the market. Now let us dive into understanding how to identify low probability and fair value gaps. And professional trading is all about filtering out the noise and taking high probability setup. A low probability and fair value gap usually form when the overall market volume is completely dead. If the candle that break the fair value gap has a linely body, a linely tiny body and massive wicks, avoid it. This shows a lack of institutional commitment and a high chance of a fag out. Another bad setup is an inverse fair value gap that form right in the middle of a consolidation when price is moving sideways. Is an range imbalance made absolutely nothing to algorithm. You must wait for price to cleanly break out for of the consolidation range first. Online trade and verse fair value gap that display clear undeniable displacement away from a core liquidity level. If this setup looks messy, confusing or forced, simply step away from the screen. Remember protecting your capital by not trading is also a highly profitable trading decision. Let's look at the exact mathematical rules of risk management for this strategy. And you can have the best strategy in the world, but without discipline you will fail. As a disciplined trader, you must never risk more than 1% to 2% per trade. If you have a $10,000 account, your maximum risk is $100. Use a prices position size calculator before you enter any live trade on MT4 or MT5. Measure the distance between your entry point and your mechanical stop loss level and put the exact peep distance into your calculator to get your proper lot size. This ensures that even if the trade hits your stop loss, you lose very little. Trading is a game of probability, and losing streak are normal part of the business. My by risking only 1%, you can survive 20 losses in all. And before you click the buy or sell button, you must check of four major conditions. Condition 1 has a major high time frame liquidity, ball being swept or mitigated successfully. Condition 2, is there a clear energetic displacement, candle breaking and opposing fair value gap? Condition 3, did the candle body close completely outside the boundary of the gap? Condition 4, is the step concretely forming and set a valid institutional decision kill zone? If up 4 conditions are met, you have green light to exact your position. If even one condition is missing, you must sit on your hands and do nothing. Having a written checklist remove all guesswork and emotion from your daily routine. It turns you from a reckless gambler into a highly precise algorithmic market operator. Write this real down on a piece of paper and paste it right above your monitor. Now let's explore how the fair value gap strategy performs during high impact noise event. A high impact noise event like SPI, NFP or FOMC create massive volatility in trading. During this event, institutional algorithm inject immense volume, creating giant imbalance. Many retail traders get wiped out because they try to guess the news direction early. The professional approach is to wait for the news release to happen first. Let the initial shock take volatility sweep at the retail stop loss from the market. Once the violence news candle settle down, look for the resulting market displacement. News event frequently create massive clean inverted fair value gap on your chart. Because the volume is so high, these news created inverse fair value gap are incredibly high probability. Wait for the post nose retracement back into the inverse fair value gap for a clean safe entry point. Never trade during the exact minute of the release to avoid dangerous broker slippage. Is the nose as a catalyst to build your institutional setup, not as a gamble. Let's move into how to effectively backtest this strategy to and to build rock solid confidence. Do not just take my word for it. Go into the historical chart data, open trading view, pick your favorite asset class and use the bar replay. And let's begin summarizing the core code of the Average Favorite Masterclass today. The chart rule number one. Always single time you see a valid adverse value gap time frame institutional is into rule number two. Never anticipate a setup, always wait for the final candle body close. Rule number three. Final outcome look for clear fast energetic displacement to validate into the zone before exploding away. Only respect the open your position and set the longest and New York encouragement. Rule number 5. Protect your capital at all costs using the strict 1% risk rule. In your chosen these rules are your shield and your weapon in the highly competitive financial market. If you violate these rules, the market will punish you by taking your hard-earned money every weekend. If you respect this rule, backtesting you will achieve the financial freedom you deserve. Review this video multiple times until these concepts are deeply into life market execution into your mind. Start by trading the average fair value gap strategy on a demo account or a macro live account forward testing for detection you to deal with the real time what element of life to become profitability actionable at home or to for 4 weeks to go find 5 clean and exactly as it on your shop. Drop live a comment below if you have any question and I will personally reply to you. Make